In this world, three things are certain: death, taxes, and financial pundits talking about the housing market crash.
There were probably junior analysts that were given the task of reviewing these documents.
Some of them think the housing market will collapse in 2023, while others say it'll happen in 2026. Analysts from the credit reporting agency Fitch believe that the probability of a severe downturn in the US housing market is very high. Home prices have fallen by 10% to 15%, and housing activity has fallen by roughly 30%. But many big shots like Michael Burry believe that the era of pandemic housing price rallies has ended. Now, keep in mind, this is Michael Burry we're talking about, the guy who famously predicted the 2008 housing crisis. In this video, we're going to find out what Burry has to say. Here are 5 reasons why Michael Burry believes the housing bubble won't pop. Stick around until the end of this video to find out how Gen Z could be a great deciding factor for the housing market's future. Number 1. The no-crash zone. Back in August, Michael Burry tweeted, "Quite a rally given quantitative tightening, right?" No. The Fed has not yet reduced its mortgage-backed securities holdings, which have increased since the start of the quarter June 1st. Higher rates inhibit refinancing, so that's not happening. They knew this, right? Right? Burry is quite right. The Fed's holdings are insanely large, and his argument actually makes sense. But why does the Fed own mortgage-backed securities? Well, the reason takes us back to the golden days of the financial crisis of 2008 and 2009, when the Fed was trying to prevent the mortgage market from collapsing. Jim Vogel at FHN Financial has explained it perfectly. He said during the crisis, every financial institution in the world had some exposure to the US housing system. Those institutions had no interest in buying more housing bonds in that environment. And, without the supply of capital, the Fed stepped in as a buyer, in effect of last resort. From 2009 through 2014, the Fed continued to add treasuries and mortgage-backed securities to its balance sheet. In 2017, the Fed began allowing some of its mortgage bonds to expire. But then, in 2020, the epidemic struck, and the Fed resumed its purchases of mortgage bonds. In the spring of 2021, the 30-year mortgage rate was 2.65%. If you took out a mortgage before, when interest rates were higher, it made sense to refinance in the spring of 2020, when everyone was ordered to stay home. In its desperation to avoid an economic collapse, the Federal Reserve instantly went for the good old 2008 strategy again. The idea was to inject money back into the economy, make sure that borrowers were able to borrow, those property valuations were still going to be relatively stable to avoid a great financial crisis 2.0. The housing market has been on a downer, but the market crash isn't even close. For a long period, the housing market may remain much slower and less liquid. And going back to Michael Burry's tweet, he's calling out the Federal Reserve for not sticking to its own plans, which he's done numerous times before, so nothing new there. By the way, do you want to stay updated on Burry's predictions? Then consider giving a like and hitting the subscribe button. It really helps me to grow the channel so I can bring you the best content about investing. Number 2. Low supply and high demand. Since the beginning of the pandemic, home prices in the United States have skyrocketed by more than 40%. Low interest rates, growing demand, and diminishing availability all contributed to the huge price increase. So naturally, home affordability in the second quarter of 2022 is at its lowest since the Great Recession. Unlike the run-up to the 2008 financial crisis, home prices have risen rapidly in the last 2 years, which is due to a lack of supply paired with high demand. The pandemic, supply chain problems, and the Ukraine crisis have increased housing inventories by delaying development timeframes and rising material prices. There was an abundance of new and available homes prior to the 2008 financial crisis. Because of the housing oversupply, mortgage lenders provided loans to anyone who could fill the extra inventory. Which brings us to the next point. Number 3. Change in lending practices. Lending is much more stringent today than it was before 2008. Subprime lending practices, which supplied mortgages to persons with low credit ratings, were the major driver of housing prices in the mid-2000s. Mortgage lenders ran out of qualified borrowers to lend to, and with so many properties to sell, they got complacent and cut corners. A commission charged by Congress to look at the roots of the crisis said lenders made loans that they knew borrowers couldn't afford and that could cause massive losses to investors in mortgage securities. Or, according to a certain Senate investigation, risky loans were the fuel that ignited the financial crisis. Today's lending practices are considerably stricter. Adjustable rate mortgage loans with balloon payments accounted for 35% of mortgage loans during the 2008 financial crisis. They now make for fewer than 5% of the population. Some real estate professionals feel that today's tough lending guidelines are actually adding to the housing shortage. When there aren't enough customers, supply starts to decrease. Then builders aren't as active. As a result, speculating in the housing market is significantly more challenging now. Number 4. Housing activity. Home prices, like any other asset, can't continue to rise forever. There are signals that the housing market is slowing. This is especially true as the Federal Reserve continues to boost interest rates to reduce inflation. We've seen a historic rise in home values over the last 2 years, and it's just not sustainable. As home prices increased, millions of people were priced out of the market, and on top of that, mortgage rates have nearly doubled since the beginning of this year, and that's slowed down the housing market even more. As prices increase, demand will certainly begin to fall. This raises the question of the housing market crash again. But if there's an oversupply of homes, the possibilities are much higher. However, there's been a sharp reduction in new housing. According to the National Association of Home Builders, single-family starts decreased 10.1% to a 916,000 seasonally adjusted annual rate and are down 2.1% on a year-to-date basis. This is the lowest reading for single-family home building since June 2020. After spiking in the first quarter of 2007, home prices fell by 20%. With the present economic conditions, property prices are expected to fall modestly or level out. Home ownership is still in great demand, and in times of high inflation, it's considered a good hedge against inflation. According to a paper published by Zillow, most existing homeowners are insulated from high mortgage rates, thanks to more than 90% of loans in the past several years being vanilla fixed rate, fully amortizing mortgages. That keeps people's current bills affordable and will prevent a foreclosure wave like the one that helped cause the housing market to spin out of control and crash in 2008. And that brings us to where all the action is. Number 5, the Millennial Gen Z era. The number of potential homeowners is numerous. Millennials and younger Americans account for half of the US population, or 166 million as of July 2019. According to the National Association of Realtors data, this is important because first-time home buyers make up 31% of all home purchases. Also, the majority of first-time buyers are under the age of 40, which means that the buyer pool is large, and that's a favorable indicator that demand will continue high, especially considering that housing inventory is at record lows. Polina Ryshikov, Senior Director of Research and Lead Economist at Sunday, a real estate marketplace for distressed properties, says, "We won't see a downturn because the housing market saw little increase in inventory for the past 10 years. In a few years, Gen Z will be turning 30 and more financially ready to become homeowners than millennials were at their age. This means that the demand for homes will be as high, if not higher, while inventory will still be behind in the demand." However, like any other generation, Gen Z faces unique hurdles when it comes to saving for home ownership. This includes the consequences of the pandemic, in which formative education and employment prospects may have been postponed for years or even halted altogether. But what do you guys think? Do you agree with Burry's reasoning, or do you have your own ideas? Let us know in the comment section below. We would love to hear your thoughts. If you enjoyed this video, make sure to watch our previous video about why Michael Burry recently sold his entire portfolio. And don't forget to click that subscribe button. I make videos like this every week where I uncover the secrets of money and markets.